Open your banking app right now. Look at your savings account. The number is higher than it was last year. It always is. That's the point of a savings account. You put money in, it grows, it slowly, safely eats, the way you were taught. You've done this for years, maybe 5, maybe 10. The balance climbed the whole time, and every time it climbed, you felt a small, quiet relief, proof that you were doing the responsible thing. Here's what that balance has actually done during the same stretch of time. It bought you less. Not eventually, continuously. Every single year you held it there, it lost ground against the price of everything around it. While the number on the screen kept rising, your account did not fail. It did exactly what it was built to do. That's the part I'm going to prove. The belief is reasonable, and it was taught to you deliberately. A savings account is FDIC insured up to $250,000 per depositor per bank. It cannot lose principal. It cannot crash the way a stock portfolio can. It sits behind a wall of federal protection that has existed in some form since 1933, and in the entire history of that insurance, depositors have never lost a single insured dollar to a bank failure. So when you kept your emergency fund liquid, when you resisted the urge to chase returns, when you left months of expenses sitting quietly in an account that only ever moves upward, you were following advice given by every financial planner, every personal finance book, every article that has ever told you to build a safety net before you build anything else. Liquidity, stability, access without penalty. These are not fantasies. They are real features of a real product, and the number confirms it. Every statement shows growth. Every year-end summary shows a balance larger than the one before. There is no red ink here, no loss column, no warning. If you did the responsible thing with your money, this is what responsible looks like. A chart that only ever goes up, a number that never punishes you for trusting it. That is the entire selling proposition of a savings account, and on its own terms, it delivers exactly what it promises. Your principal will still be there tomorrow. Nobody said anything about what tomorrow's dollar would actually be worth. Pull up your account's interest earned for last year. It's usually a single line, easy to miss. Compare it to what you paid for groceries the same month, or the last time you filled a gas tank, or what your rent or mortgage payment does now compared to when you opened that account. The interest number is small. It has always been small. Most people never look at it directly because there's nothing dramatic to look at. No crash, no red warning, no headline. Just a quiet, structural gap that never announces itself. Here's the gap made visible. As of mid-2026, the national average savings account pays roughly 0.38% annual interest. Some of the country's largest banks, the ones with your paycheck on direct deposit, the ones with a branch on your corner, pay closer to 0.1%, which on $10,000 works out to about $1 a year. Meanwhile, prices across the economy have been rising at an annual rate of 3.5% as of last month, after peaking above 4% in the spring. The math does not need a calculator to feel wrong. The rate your money earns and the rate prices climb are not close. They were never designed to be close. You were never told this at account opening. Nobody hands you a chart at the branch that shows interest earned against inflation over the same period. The paperwork discloses your APY. It does not disclose what that APY means once you set it next to the cost of living. That comparison is left for you to make on your own if you ever think to make it, and most people don't because the account is doing exactly what it visually promised. Rising number, untouched principal, no loss column. But there is a loss column. It's just not printed on your statement. It's printed in every price tag you've paid since the day you opened the account. The mechanism has a name, the safe-looking loss. It works because two different kinds of safety have been merged into a single word, and almost nobody separates them. The first kind is nominal safety, the protection of the number itself. Your principal cannot disappear. Nobody can subtract from your balance without your authorization. If the bank fails, the FDIC replaces your money up to the insured limit. This protection is real, well documented, and has held since it was created in 1933. In direct response to the bank runs of the Great Depression. when thousands of institutions collapsed and depositors lost everything overnight. The insurance was built to solve exactly one problem: the risk that a bank might vanish and take your money with it. It was never built to solve a second problem: the risk that your money, while perfectly present, might quietly stop being worth what it used to be worth. Those are two separate kinds of loss, and only one of them wears a warning label. The second kind is real safety, the protection of what your money can actually buy. Nothing in the structure of a savings account protects that. Inflation is not an attack on your account. It doesn't touch your principal, doesn't trigger a fee, doesn't show up as a deduction anywhere in your statement. It works on the other side of the transaction entirely, on the price of everything your money would be exchanged for the moment you tried to spend it. Your bank has no obligation to compensate for that, because nothing in your account agreement promised to. It promised to protect the number. It did not promise to protect the number's meaning. This is where the current form of the mechanism becomes visible in the actual figures. As of mid-2026, the FDIC's national average savings rate sits at roughly 0.38% APY. Inflation, over the same period, is running at 3.5% annually, after touching a 3-year high above 4% earlier this year. That gap, the difference between what your money earns and what prices are doing, is not a temporary glitch in an unusual year. It is close to the historical norm. Traditional bank savings rates have spent most of the past decade sitting near zero, occasionally rising during aggressive Federal Reserve tightening cycles, then sliding back down the moment that pressure eases. Inflation, meanwhile, rarely cooperates by staying equally low. The two lines are not designed to track each other. They were never wired together in the first place. Now, who profits from that gap? The federal funds rate, the rate banks themselves earn lending to each other overnight, effectively risk-free, has recently sat around 3.75%. That is, the rate the banking system considers a fair return on parked cash. It is not the rate most banks pass on to you. A large national bank holding your deposit can, in effect, borrow your money at 0.01% and deploy it through lending, through treasury holdings, through the overnight market, at a rate nearly 400 times higher. The spread between what you're paid and what your money earns for the institution holding it is not a byproduct of the system. It is the business model of the deposit side of banking, and it has existed in some form for as long as banks have taken deposits. This spread does not just apply to one account or one saver. It is happening at this exact moment across every traditional savings account in the country, which means the true scale of it is not measured in one person's missing interest. It is measured in trillions. We'll come back to exactly how many. The gap also isn't static, and its history explains why almost nobody notices it forming. In 2020, savings rates and inflation were both low. The gap was narrow, and the mechanism was nearly invisible. Then, inflation accelerated sharply through 2021 and into 2022, while savings rates stayed pinned near zero because the Federal Reserve hadn't yet started raising its benchmark rate. That created the widest version of the gap in decades, a period when the national average savings account was earning close to nothing, while prices climbed by more than 8% in a single year. Rates did eventually rise as the Fed tightened policy, narrowing the gap somewhat by 2023 and 2024. But narrowing is not closing. The account was never designed to close it. It was designed to track the Fed's policy rate loosely, with a lag, and with banks keeping a healthy share of every increase for themselves before any of it reached your balance. There's also a reason banks don't have to fix this, even when customers could, in theory, simply leave. The average person keeps a relationship with their primary bank for close to 18 years, according to industry survey data, long past the point where switching would take more than a few minutes of comparison shopping. That length of relationship isn't accidental loyalty. It's the direct result of how deeply a checking account gets wired into a person's life. Direct deposit, auto-pay, a mortgage or car loan at the same institution, a debit card memorized by every subscription service. The switching cost isn't financial. It's logistical, and it's high enough that most people never run the math that would make switching worth the hassle. Banks do not need to compete aggressively on savings rates for deposits that are, functionally, already captured. The product itself is not lying to you. A savings account genuinely will not lose your principal. That promise gets kept, reliably, every year, which is precisely why the loss underneath it goes unnoticed for so long. A mechanism that stole visibly would get fixed. A mechanism that preserves the number while quietly hollowing out what the number means can run for decades, because the only evidence of the loss is something you'd have to go looking for: a receipt, a price tag, a rent increase, rather than something the account itself will ever show you. Consider a composite case built from aggregate savings and inflation data rather than any single real account. Call him Daniel Okafor, 43, an IT infrastructure manager outside Charlotte, married with 2 kids, household income of $158,000. In early 2020, Daniel did the responsible thing. He built a $58,000 cushion, 6 months of expenses plus a margin, and parked it in the savings account attached to his primary checking at the same bank he'd used since college. He didn't shop for a better rate. He didn't need to. The point wasn't yield. The point was that the money would be there, untouched, whenever he needed it. He'd built the cushion in the first place because his company had gone through a round of layoffs that spring, and watching colleagues walk out with a bong and a severance check had left him with a specific, physical kind of anxiety he wanted to solve permanently. $58,000 felt like the solution. It was 6 months of runway, converted into a number he could check whenever the anxiety came back. For 6 years, Daniel checked that balance the way people check things they're proud of, not obsessively, but regularly, with a small private satisfaction each time. The number went up. Interest posted monthly, a few dollars here, a few more there, exactly as promised. By 2026, his balance sat close to $59,000. Modest growth, but growth felt like proof that the plan had worked. He had not touched the principal once. He had done exactly what he was supposed to do. The crack came from an unrelated errand. Daniel was helping his daughter with a school project on cost of living and pulled up an inflation calculator to show her how prices had moved since she was born, in 2020. He typed in his own cushion amount out of curiosity, $58,000, 2020 to 2026, and watched the tool convert it. To hold the same purchasing power his cushion had the day he opened the account, he would now need close to $75,000. He had 59. He sat with that for longer than he expected to. The account had not lost him a single dollar. Every statement for 6 years had shown exactly what it was supposed to show: stability, growth, an unbroken record of doing the right thing. And somehow, underneath all of that, roughly $16,000 of real value had evaporated. Not through any mistake he made, not through any fee he was charged, but through the simple, silent fact that his money's growth rate and the economy's price growth rate had never been moving at the same speed. $16,000 is not an abstraction to a household budgeting for 2 kids. It's close to a full year of his younger daughter's daycare tuition. It's more than what he'd spent in total on every family vacation since 2020 combined. He didn't lose it in a single visible moment. No bad month, no bounced check, no dramatic mistake he could point to and learn from. It came off in amounts too small to register, spread across 2,190 days, inside an account that never once flagged the erosion as a loss. Daniel is not reckless. He is not undisciplined. He did not chase a risky investment or fall for a scam. He followed the standard advice, kept his emergency fund liquid and boring exactly as instructed, and the account performed flawlessly by its own definition of performance. What curdled, watching that calculator, wasn't guilt. It was the quiet, specific disbelief of realizing that doing everything right and losing money had been happening in the same account at the same time for 6 straight years, and nothing in the entire relationship with his bank had ever surfaced that fact to him. He hasn't moved the money. That's the part he can't quite explain, even to himself. He understands the mechanism now. He can do the math, and the cushion is still sitting in the same account it was in 6 years ago. Understanding a mechanism and acting on it, it turns out, are two different problems entirely. Daniel's $58,000 is not an isolated case. According to Federal Reserve data, savings deposits and other checkable deposits held in the United States total roughly $10.85 trillion. That figure includes emergency funds, house down payment savings, retirement bridges, business reserves, money that millions of people have deliberately chosen to keep liquid and safe rather than invested, for exactly the reasons Daniel chose it. Here is a hypothetical calculation, useful for scale rather than as an exact figure. If even a meaningful share of that 10.85 trillion sits at something close to the national average rate of 0.38%, while the federal funds rate, the benchmark for what that same money could be earning risk-free, sits around 3.75%, the spread between the two is roughly 3.37 percentage points. Applied illustratively across the full deposit base, that gap represents several $100 billion a year in foregone interest, redirected away from depositors and toward the institutions holding their deposits. This is not a precise corporate profit figure. Banks carry costs, reserve requirements, and not every dollar sits at the lowest rate, but it illustrates the order of magnitude of what's structurally at stake when an entire country parks trillions of dollars in accounts built around this particular spread. The distribution of that spread is not random either. Large, branch-heavy banks, the names most people default to because a parent had that account or a college orientation table set it up for them, tend to sit at the bottom of the rate ladder. Some of the largest institutions in the country, holding trillions in combined assets, post standard savings rates around 0.01%. Online banks with no branch network to fund compete much harder on rate, some reaching 4 to 5%. The gap between those two numbers is not a technology story, it's a loyalty story. Industry research has found that a saver using $10,000 at one of the largest traditional banks can forego several $100s in interest over just 2 years, compared to a competitive online account carrying the same FDIC protection, the exact same insurance Daniel was relying on, just priced completely differently depending on which institution holds it. That loyalty is worth protecting from the bank side because it's durable. The average customer stays with a primary bank for close to 18 years. Over a relationship that long, the cumulative gap between the lowest and highest available rates on an unchanged balance compounds into a figure most people never calculate because no single year of it looks alarming enough to trigger the comparison. This is the scale underneath every individual safe decision. It is not that any single saver is being targeted. It's that the entire architecture of traditional deposit banking runs more profitably the longer money sits in low-rate accounts, held by people who trust the number they see and never run the second comparison against inflation, against the federal funds rate, against what the same insured protection would cost them at a different institution entirely. So redefine the word you started with. Safe was never one thing. It was always two different promises, sold under a single label. Nominal safety, the promise that your principal won't vanish, is completely real and completely intact. Every dollar Daniel put into that account 6 years ago is still there, plus a little more. Real safety, the promise that your money will still buy what it used to buy, was never made in the first place, not in the account agreement, not in the marketing, not in the advice that told him to build the cushion. He assumed it. Almost everyone assumes it because the two kinds of safety feel identical from inside a rising balance. That's the actual mechanism, stripped of the specific numbers. A product can deliver exactly what it promised, in full, for years, while a completely different form of loss operates in the space the promise never covered. Nobody lied to Daniel. Nobody lied to you. The bank did not promise your money would keep pace with prices, so it isn't in breach of anything by failing to do that. The gap exists because the product was only ever built to solve one specific problem, the fear of a bank collapsing, and that fear, while historically justified, is not the only way money quietly disappears. This reframe changes what the number on your statement actually tells you. A rising balance is evidence that you haven't lost principal. It is not evidence that you haven't lost value. Those used to feel like the same fact. They aren't. And once you've separated them, you can't fully merge them back together. Every future glance at that number will carry a second, quieter question behind it. Not is this growing, but growing relative to what? Nothing about this makes the account wrong to have. Liquidity still matters. Access without penalty still matters. The insurance is still real. What changes is the label you put on what that account is actually doing for you. Not building your wealth, not keeping pace with the economy around you, but holding your principal still while everything priced in dollars keeps moving. That's a narrower job than safe usually implies, and it's the only job this particular product was ever built to do. The wider lesson isn't really about savings accounts. It's about what happens anytime a product's marketing borrows the full weight of a word, safe, secure, guaranteed, while only ever intending to earn the narrowest version of it. The word does the persuading, the fine print does the defining, and the distance between those two things is exactly where a mechanism like this one is built to live, undisturbed, for as long as the balance keeps its shape. Your savings account kept every promise it made. It preserved your principal exactly as advertised. It just never promised to preserve what that principal was worth, and you were never told the difference. When was the last time you actually pulled up the interest your savings account earned this year and set it next to what your groceries, your rent, or your gas actually cost over the same 12 months? The savings rate gap is one mechanism, but the reason it exists, who benefits from it, is a story most financial advisors will never tell you.